In this video, you learn everything that has to do with leverage and most importantly, the impact it has on day traders, both its advantages and disadvantages. And please don't forget to like and subscribe to the channel. It really helps a lot to push this content to the next person who probably needs the same information. Welcome back to my YouTube channel. So now I've prepared a presentation to simply illustrate and explain with real life examples on how leverage works hand in hand with margin, position sizing, lot size as many would call. So now let's begin. Moving on, right? What is leverage? Leverage is having the ability to control a large amount of money using none or very little of your own money and borrowing the rest. So now, when it comes to leverage, you are basically using borrowed money to invest in a currency, stock, or security. Now, this is the interesting part. When borrowing money from a broker, investors can trade larger positions in a currency. That is, with higher leverage, the lower the margin required to open a trade. Now, as a result, leverage magnifies the returns from favorable movements in a currency's exchange rate. This is why high risk traders like myself normally prefer higher leverage as possible. Because basically, with low leverage, you are going to make little to nothing in profits. Now, moving on. However, as we know, leverage can be a double-edged sword, meaning it can magnify your losses. And again, it's very crucial that forex traders learn how to manage leverage and employ good risk management strategies to avoid big losses. Moving on. For example, an investor might buy the euro versus dollar with the hope that the exchange rate will eventually rise. The trader would then unwind the position a few hours later by selling the same amount of euro USD back to the broker using the bid price. So now, the difference between the buy and sell exchange rates would then represent the gain or loss on the trade. If now, let's say you choose to control 100,000 US dollar, your broker will now set aside 1,000 US dollars as collateral damage, which is now expressed as 100 is to 1 in ratio. Now, this is what we call leverage. Now, let's use Euro USD for illustration purposes. Let's say this number here, which is the current market price. If now Euro USD was to rise by a pip, this would mean this lot sizes. Rather, this would happen with this lot sizes. With 0.01 lot, you would now make 0.1 US dollars. With 0.10 lot, you will yield a dollar. Now, with a standard lot, which is a 1.00 lot, you will then yield 10 US dollars. So now, how to calculate pips? So now I'm going to show you how we calculate pips using the above market price, which is 1.734548. So now, number one, if price comes to this point right here, this is the current market price. Let me label this for you. This is the current market price. Sorry. That's the current market price. You see this figure right here? This is the current market price. So now, if this price moves up to this price over here, which is this the numbers after the decimal, which is 73648. If it rises to this number here, then it means price would then have increased by 10 pips. Okay, that's the scenario if price moves up in that manner. So now, still with this current market price over here, If it decreases now to this number now, which is 73448, it will mean the market price decreased by 10 pips. I'm not sure if you understand. From here, the price increased to this market price here, and then it increased by 10 pips. So the difference now will be between the current market price and the previous one. That's how you find if whether price moved up, the range between the market, the current market price and the previous current, the difference between the current market price and the previous one. I'm sure you get the point. Okay. All right. Let's remove all that, and then let's move on to the next slide. Forex lot sizes. Moving on, we have different lot sizes in the package. So number one, we have standard lot size, which is 100,000 units. We also have mini lot size, which is 10,000 units, followed by micro lot, which is 1,000 units. We also have a nano lot, which is 100 units. You can also trade Forex with fractional lot sizes. That is, you can trade 1.5 standard lot, 2.5 standard lot, 3.5 mini lot, 2.5 nano lots to micro lots, and etc. etc. To recap now to sum up almost everything that we've learned, leverage is having the ability to control a large amount of money using none or very little of your own money and borrowing the rest. Number two, leverage can be a double-edged sword, meaning it can also magnify wins and losses. Now remember, leverage can make or break you as a trader. Hence the need for you guys to employ good risk management strategies. We also touched on how to calculate pips in relation to lot sizes. That is your standard lot, mini lot to nano lot. So now that's it from me, guys. Till we meet next time.